Hi everyone, welcome back to the Market Chat. My name is Richard Moglen. Joining me today is my guest, Puru Saxena, growth stock investor and former money manager. Puru, thanks so much for being here. Welcome to the show.
My pleasure, Richard.
Awesome. So I always like to start things off by learning a little bit more about my guest's background and how they first got interested in the stock market and investing. So do you mind kind of going through, I guess, your journey and where you've kind of started and now where you're at now?
For sure. I started professionally investing and trading in 1998. I started off as a trader for Hang Seng Index futures and commodity futures. I did that for about a year and a half, and then I started working for a British asset management firm as a portfolio manager. And then in 2001, I basically branched off on my own with two guys from that firm, and we set up our own business here, investment management firm here in 2001. So we were three partners, including myself, and we had about 15, 17 staff when we started. And then in 4 years, the business really took off, and we had about 150 people in 2004 and 2005. And then in spring of 2005, I decided to branch off on my own and set up my own boutique investment management firm here in Hong Kong. So we managed investment portfolios for high net worth individuals, family offices, companies, and so forth. So I did not actually set up a fund because a number of the clients that I was dealing with, they did not want to pool their money with a collective investment scheme or a fund. They wanted to have the freedom to basically have their own segregated account, because I was managing money for a lot of wealthy tycoons here and family offices and so forth. And they said, look, we would rather prefer the transparency of having a segregated account as opposed to a fund, because then we know exactly what we own. We can buy and sell when we want. We're not bound by redemptions from other people and all that kind of stuff. So it was difficult for me to run separate accounts. But bearing in mind the client's wishes and the investors' wishes, I decided that was the best route for me.
Right.
So I didn't go with setting up a hedge fund. I was just managing approximately $400 million via segregated accounts, and we used to basically invest all over the world in stocks and stuff, and we used to do a bit of leverage for those accounts which wanted a bit of leverage. I did that for about 15 years, from 2001 until 2016, and then in January 2016, I returned investors' capital, and then my business itself, my company, and the infrastructure, etc., was actually bought out by a listed company here in Hong Kong. So I was, as part of the deal, I had to stay on as a responsible officer for the transition period for about a year.
Right.
And that didn't really involve any day-to-day operations. I was just the responsible officer to get past the Securities and Futures Commission's guidelines and requirements. So I did that until 2017. And then for the last 4 or 5 years, I've just been investing my own capital and just enjoying the retired life.
Awesome. Sounds great. And what first kind of spurred your interest in the stock market? How did you first decide, I want to go out and buy shares of this company? What kind of got you interested in the very first place?
Well, my dad was a businessman. He was actually in the financial services business. So he had his own firm. My dad started off as a professor in a university. And then he got really interested in the stock market at a very early age. And he basically used to go, in the old days, to the actual exchange every single day on the floor. And then eventually he decided that he wanted to set up his own firm. So he set up his own firm. He quit his day job, and he had a pretty decent business. So when I was growing up, I used to see him poring over these annual reports and looking at these charts and everything else, and his weekends used to be taken up with this stuff, and I found it quite intriguing.
Yeah.
So he said to me, once I was a teenager, he said, "Look, son, you've got 2 months off during your summer break. Why don't you come over to my office and I'll give you a bit of pocket money? But if you're interested, come over and have a look at what I do and have a look at the setup." So I had nothing better to do, so I said, "Okay, I'll go along." So for a couple of years, or 2 or 3 years actually, in the summer months, during my summer break, I went to see his, operations, and I really enjoyed, what I saw and the work itself. The idea of, being able to make money by just investing money and not doing much appealed to me. I've always been a numbers person from the very beginning. So the whole idea, appealed to me. I just found it fascinating that, this was the biggest game in the world. If you got it right, you would make a lot of money, and you didn't have to actually work for anybody. You weren't bound by the 9 to 6 routine and slogging in an office,
Right.
and waiting for, promotions and, all the office politics and all of that kind of stuff. So I just thought, this was really good. So that's what, I did a Bachelor of Commerce honors degree, and I sort of learned accounting, economics, and all that kind of stuff. And then I was headhunted by this firm in Hong Kong as a trader, which was fantastic because, I got to do what I loved. And I really enjoyed trading, but it was quite stressful because you got to, stare at screens all day long. Is very different than investing. And it was quite stressful. So I thought, maybe I want something more longer term, which is why I branched off and joined this British asset management firm, Richmond Asset Management, here in Hong Kong.
Awesome. It's so great that you got exposed to that at such a young age from your dad. That definitely gave you a step ahead of most people. That's awesome. I want to ask you, because it's very interesting. You managed hundreds of people when you were managing money for your own firm. How different is it doing that versus managing your own money, where you kind of have to wear all the hats, do the fundamental research, as well as doing the actual buys and sells?
Well, managing people has never actually been my strong point. Has never been my forte. We were 3 people when I was part of that big firm. There were 2 other partners also. So I was more on the investment side, and I used to write the investor letter and, come up with the investment strategy for the firm. We had another partner who was basically a Canadian Chinese guy, and he was a bit older. So he spoke the language because I'm in Hong Kong. So he was responsible primarily for managing the office staff and the sales guys and everybody else. And then the third partner, he was slightly older as well than me, about 12 years older than me. He was a British guy, and he was more responsible for the strategy for the business. He was the CEO of the business. So we had a good sort of match for a number of years. So coming back to your question, I have never been a big fan of managing lots of people. It's just not what I enjoy doing. I enjoy managing money and investing and researching companies. That is what I really enjoy doing. So when I actually left my firm, this big firm with 2 other partners, I made a decision not to actually expand in terms of the number of people. So I kept the operations of my own firm fairly sort of lean. We had 8 or 9 staff, that was it, but we were managing around $400 million. So basically it was me, there was another responsible officer, and another guy, and then a bunch of admin staff and operations side. I never really had a massive sales force. It was just word of mouth. I used to do a lot of media work. So I used to have regular monthly columns here for newspapers, the South China Morning Post. I used to write a column every month for the Sunday Money. And I used to write columns for the Hong Kong Business Magazine, the Hong Kong Economic Journal, Hong Kong Economic Times. I was a regular guest on BBC, CNBC, CNN, and a local radio channel here. So I had quite a high profile. So I never really had to, have a massive sales team to actually go and look for investors. I used to put out my work out there. Right. And then people just call me and say, look, we like your thought process. We like how you think and what you do. So they used to just call up and come in and see me. And I used to just see the investors in our office. And the business just took care of itself through word of mouth, which was very nice. So I actually got to do what I enjoyed doing, which was actually investing. And then in the end, after doing it for 15 years, from 2001 until 2016, I thought, maybe enough is enough. And I had a couple of other reasons also, which I won't go into detail, but I decided that was time for me to actually call it a day from investment management professionally and just focus on my own investments.
Very cool. And along the way, has there been any particular books that really helped you and kind of gave you that process and taught you a few things that you think is very beneficial and you might recommend to new investors out there?
Absolutely. I mean, I read, like most people, in the early days, I read The Intelligent Investor and a couple of other books, which all sounded very good in theory, but they didn't really prove to be very useful, at least to me anyway,
Right.
simply because the cheap stuff remained cheap and the expensive stuff just remained expensive and even more expensive and handed out massive returns. So I thought, hang on, there is something not right here. All these value names don't really go up very much. And all the other stuff, which is perceived to be overvalued, tends to run for months and years and makes a lot of money for shareholders. So then I came across, the work of Mark Minervini. He has written a couple of fantastic books. I also read, How to Make Money in Stocks by William O'Neill. But trading, as I said to you, it was never really something which interested me a lot because, I'm more sort of chilled, relaxed person by nature, so I don't really like to actually constantly look at trading screens and,
Right.
always be on the lookout for new stocks and scans and all of that. That's a bit too hectic for me. I actually looked at, the winners over the last 10, 20, 30, 40 years, and I realized that only a handful of companies actually produce the vast majority of the returns. So I thought to myself, maybe, investing in those businesses and just staying the course perhaps is a better idea, both in terms of my own psychological makeup as well as what actually has worked in the past. So I decided to go down the long-term investment route, and then I came across Phil Fisher's book, Common Stocks and Uncommon Profits, and I always keep it here in my office. It's here. This is a fantastic book. This is basically by Bible, or basically this is what actually shaped my investment thesis, and whatever Phil Fisher wrote, decades ago, just sat very well with my own logical brain. And then I also realized that, whatever he wrote back then was still pretty true now. And, I just learned a lot from him. I also learned a lot from Peter Lynch's teachings and his books. So, I just realized over time that, investing in high growth businesses in the long term, secular compounders, was quite a fruitful endeavor, and it continues to be.
Very cool. So getting now into your trading strategy, or actually investing strategy rather, take me through the steps here from the initial idea. Maybe you start with the industry group, you see a sector that's strong in the market. How do you go from that very first idea all the way up until buying shares? What's kind of your process in researching companies, picking the best ones, and then finally deciding this is the point that I want to buy?
Well, Richard, I look at, the secular major themes or the trends, which are basically prevalent at the time. So I like to, swim with the tide, with the wind behind my back, as opposed to basically swimming upstream and basically not going anywhere. So I look at those sectors or those areas which are likely to, grow a lot over the next 5 to 7, 10 years, perhaps.
Right.
And those are themes which are still early in the S-curve adoption phase. So generally, I have found that, new services, new products, new technologies, which are just breaking into the mainstream, and those companies which actually bring those technologies and those products and services to market, they tend to do very, very well from, the IPO phase for like 7 or 8 or 10 years, if they have a very large TAM and runway. So I try and look at those areas which are likely to, really infiltrate society and be, widely adopted by human beings. And then I try and look at, these companies which are at the forefront of those changes. And then if those are actually trading at a cheap or a fair valuation, they're seldom cheap unless you are in a recession or, in a panic of some sort. But if they are trading at what I perceive to be a fair valuation, then I try and invest and stay the course. But I also, I'm quite inquisitive by nature. So I also try and always keep an eye out on new listings and new issues. So sometimes just to better follow the company, I may have a little starter position of maybe 0.5% or 1% of my overall portfolio, just so I can track the company better and really think about the business as an owner, because I have a little bit of skin in the game.
Right.
And if I don't actually like the company, or if I have sort of doubts, or if I'm not 100% certain, I sell out, and likewise, if I have a high conviction idea, and if the stock falls, and if the overall thesis of the business is unchanged, and there's nothing fundamentally wrong with the business, and the business is not impaired and just the stock is currently down for whatever reason, I add more to that company. And because we've had so many IPOs over the last couple of years, as you know, so many disruptive, innovative companies coming to market, my portfolio turnover has been sort of higher than normal, much higher than normal. But my interest is to try and maximize my returns as a shareholder, as an investor. So my emphasis has always been on portfolio CAGR. I'm not really interested in what the portfolio turnover is or whatever. I think that's just incidental. What matters is how much you make in this business when you're right and how much you lose when you're wrong.
Right, absolutely. I think Mark Minervini, in one seminar that I watched of his, he says the best fund managers actually often have the best turnover because they're looking for those new themes emerging and those new disruptive stocks and taking advantage of them. So I think that's great. How much of your process would you say is fundamental based versus actually looking at a chart and doing some type of technical analysis to determine the trend of that stock or the overall market?
Well, the vast majority of my work is driven by fundamentals. So I look at the company's positioning, their competitive advantage, how durable is that advantage, what is the management team like, what has been the past revenue growth, where are the margins, are they trending in the right direction, in the wrong direction, what does free cash flow look like, what does the path to profitability look like, what are the projections of the analysts on Wall Street who actually track this business very closely, what are they saying about the growth projections, what is the management saying, how transparent is the management, is it trustworthy or not, do they change their tune very often? Mm-hmm. So these are some of the factors which come into my mind when I am evaluating a company. And now I've been doing it for so long, it's become almost like second nature. When I see something which really kind of jumps at me, I know pretty much immediately after even looking at it for half an hour or an hour, I know whether this is a business worth researching more, or if this is a business which is not really grade A, as I like to call it. And also, I'm quite picky these days about the companies themselves or the industries which they operate in, because I have actually learned over time that those businesses which basically have repeated sales to their customers, where the customers buy on an ongoing basis, where they are recurring revenues, or where there is less cyclicality in the business, those businesses tend to do very well. They are more stable in terms of the stock performance, and also tend to do very well. And that makes a lot of sense, because if you are a software business or an e-commerce business or fintech business or even an online gaming business where your customers tend to use your services and products repeatedly on a daily basis or a weekly or monthly basis, that to me is a lot better business than, say, a company which sells durable goods or a company which sells, mining equipment or tractors and so forth. Because there, the customers, they don't shop very often. They come and buy a product once every few years, and then they disappear. And then the revenue curve of that business looks like this. And then the stock price also does this, because it's highly cyclical, it's boom and bust. Mm-hmm. And that okay if you want to play that game, but for that, timing is essential. You have to be able to buy the cyclicals when they're out of favor and be smart enough to know when the tide is going to turn on the downside. So you've got to book your gain and get out. I just prefer to own those businesses where the customers tend to stay. They spend more and more over time, and then they make repeated purchases. And where the company has some sort of network effect, whether it's high switching costs or whether it's just scale, whether it's something else which basically compels their customers to actually go back to that business over and over and over again. And that's when you build a durable franchise. That's where you build a durable business, because if you are a businessman or a businesswoman, and if you have a business where that your current customers are locked in, they cannot get this service anywhere else, I'm sure you will sleep a lot better than being an owner of a mining business or a tractor producer or somewhere where you basically sweating every night and wondering when your customers are going to come back, because the customer pool is not expanding very much. And those customers who bought expensive item recently, they're not going to come back 6 months or a year later and buy it again. So you have to be careful of the type of business that you actually invest in. And if you look at Warren Buffett, if you see how he has made his, billions, he invested in consumer staples, insurance companies, consumer staples. And he realized, decades ago, that's why he's one of the richest people in the world and one of the shrewdest investors, that, the stability of the cash flows is very important. And that is exactly what I'm saying now, that, he wasn't interested in boom and bust businesses. He wasn't interested in commodities or commodity producers and so forth, because those producers were actually price takers. They were not price setters. So as a business, if you want to invest in any business or any company, you want to own those companies which basically are in charge of their own destiny. In other words, those businesses which are price setters, not price takers. So if you are, the CEO of a gold mining business or an oil company, you have absolutely no say over what your sales will look like, because it will all depend on the price of the underlying commodity. Whereas if you are a software business, or if you are a fintech company, or a gaming platform, or a platform of some sort, then obviously you have more say over the price that you charge your customers. And I think that is a very big advantage. You have to look at those businesses which have some sort of pricing power, in my view.
No, it makes perfect sense. I completely agree. And it's interesting. A lot of the stuff you're saying from the investing side of you is actually aligns quite well with what I do. Even though I'm swing trading, I'm position trading, these type of names, I'm still focused on the same type of areas and the same type of companies. So it's very cool how everything lines up. And you just mentioned a few of these, but what are some kind of main areas and industries that you're focused on in 2021 and also going into the next 5 years or so?
I mean, for the next 5 years, I think, e-commerce is going to remain a big beneficiary, especially in the developing world where the penetration rates are very low. If you look at, regions like Southeast Asia, if you look at Russia, if you look at Latin America, e-commerce as a percentage of total retail sales is still very, very minuscule. And I think if they follow the same path as the developed world, i.e., the US or China or Japan, not so much Japan, but China and the US and the UK, then I think there is a long runway for growth in the developing world in e-commerce. So I own shares of Mercado Libre, I own shares of Sea Limited in Southeast Asia. I've invested recently in OZON, the Russian e-commerce business. I also think payments, online payments and fintech is going to be a high growth area for the next few years, simply because as more and more business is done online, people will want to find means of payment. Nobody wants to make payments via checks and cash upon delivery. So most people prefer the ease and convenience of using a PayPal or an Adyen or a Stripe gateway or something like that. So I think fintech and payments is going to be a pretty high growth for the next few years. I also think that the whole EV space, the green energy space, is going to be quite interesting over the next 10 years, maybe 10, 15 years, because I think people are underestimating how quickly EVs are going to ramp up and how quickly EVs, in my view, over the next 10, 15 years are going to be the vast majority of the vehicle fleet in the world. It's a no-brainer. I mean, if you have the technology to actually run the fleet, the vehicle fleet in the world without polluting the planet and without trashing the resources, whether it's EVs or it's hydrogen. I'm not really a scientist, so I cannot comment which technology is going to basically lead, but I'm pretty sure that our reliance on fossil fuels is going to go down, and I think that's going to have a big impact on the vast majority of companies. So, all those businesses which made a fortune over the last 50 years from this fossil fuel era, I think are going to struggle. So the oil majors, the refineries, all the ancillary businesses which basically supported this industry, I think are going to have serious problems. The companies which are set up for the EV boom, the boom in renewable energy, are going to do quite well. And I think the industry itself is going to do pretty well, but it's quite difficult to pick companies. Obviously, with the benefit of hindsight, Tesla was a fantastic investment. But realistically, how many of us knew 10 years ago, that this company would become what it is today? It was, up until 2 or 3 years ago, a lot of people were calling for Tesla's bankruptcy because, even Elon Musk admitted recently that it was touch and go for a long period of time.
Right.
So you have to be extremely lucky in picking winners in this area. So I've actually limited my investments in this area. I mean, I've got exposure to this space via Lucid Motors, which I think is quite an interesting business. It's not a slam dunk by any shape or form, but I like the management. I like the car that they've built, and I just think that they have a fairly decent shot at being quite successful over the next 10 years or so. I've also invested in Proterra, which is the EV battery and grid and the bus business. And they also have revenues already, and I think they also have a fairly decent chance of being a decent player in this space. So these are some of the investments in the EV space. I also think that online gaming is here to stay. The whole metaverse thing, with more and more kids spending a lot more time online, playing games. And games are not games anymore. They have become social platforms.
Right.
These kids, they spend hours every day on these platforms, and all their friends are on there. They're chatting on there, they're buying stuff, they have their own avatars in cyberspace, and they're all kind of competing with each other. So it's basically taken on a life on its own. So I think the gaming space looks quite interesting, and I'm a shareholder of Skills. Skills has got some fantastic estimates, growth estimates going out 4 or 5 years. I like the CEO, Andrew Paradise. He's got skin in the game. And the stock has been beaten down over the last 2 or 3 months because of the sell-off in the growth space. But I think, these sort of valuation, at this valuation, I think Skills looks quite an interesting proposition for the next 4 or 5 years. Apart from this, I also think, the cloud business is going to do very well. So, data, analytics, software as a service, I think this space has a long runway. I mean, a lot of the companies that I own have forecasted or predicted a 30% plus revenue CAGR over the next 4 or 5 years, which is fantastic in a world where, growth is hard to come by. So software is another area which I like very much. And another interesting trend has caught my attention, which is the EVTOL space, the electric vehicle, vertical takeoff and landing space, where you have air taxis or electric air taxis or helicopters, which are going to apparently, take people from locations within the city to, say, the airport or somewhere else. And the technology looks quite interesting and promising. And I've read articles recently in Hong Kong in the South China Morning Post, where they're saying that the Hong Kong government, or one of the companies in Hong Kong, has actually recently signed a deal with Chinese EVTOL manufacturer EHang, and they are going to launch an EVTOL service here within the next 2 or 3 years, which will be fascinating to watch. Because if this technology turns out to be viable, which I think is the case, then I think a lot of money will be made investing in the key players. So I own shares of Jobi Aviation. The ticker is RTP, and it's still pre-revenue. But I think if this EVTOL space takes off, and of course there are some question marks now in this space, because how will the air traffic be managed? How will these EVTOLs take off? We're going to build like massive helipads and stuff. So there are a lot of question marks, like there are in any industry in the beginning. But I think Jobi Aviation looks quite interesting, from the next 5 to 7 years. So these are some of the areas that I'm focusing on. I think most of them are pretty sort of certain bets at this stage. But in the investment business, as as well as anybody, certainty doesn't exist. Anything can happen. So I'm always open-minded. I'm looking for new information and data, which would basically cause me to change my mind. But for now, I don't really see any major red flags with these industries.
Very cool, very cool. And I'm definitely looking in many of those same areas, as I said. And you mentioned something that I wanted to ask you. For RTP, you said it was pre-revenue. So it's just kind of going off story at this point. For a core position, so you've got a significant amount of your portfolio in that. Are you waiting for sales growth to be there, earnings growth to be there before you establish a core position? Or is the story enough? And if you believe in the company, you believe in the management, that's enough for for you to establish a full position?
I've got about 3.5% of my portfolio invested in Jobi. So it's not a small position, but it's by no means one of my larger positions, which are up to 7 or 8%.
Right.
So it's sort of a medium-sized position because I have faith in the management. Reid Hoffman is a very smart guy, the guy who basically brought this to market. Mm-hmm. So I like the quality of the management team, the backers. I think the technology is legit. If you go to YouTube, you can see a promo which the CEO Jobi recently did with his aircraft basically taking off in the background when he was talking, and it wasn't noisy at all. So they have already built the prototype. They've got, I think, 1,000 hours of flights under their belt, so they have collected a lot of data already. And I think now it's a question of just waiting for all the regulatory approvals to be obtained and so forth, and the technology to actually prove that it's viable, so it can take off. I think, the technology will take off. No pun intended, but I do think that it is a valid technology. If I'm right, and if this business proves to be viable, I think this stock could be a 10-bagger over the next 10 years. So I'm willing to, risk 3.5% of my portfolio when the risk reward is so, skewed to the upside. And if I'm wrong, well, even if I lose 30%, it's just going to be a 1% hit to my account equity. It's not going to kill me either way.
Absolutely. And I definitely want to get into that later on, how you manage your risk, which we've talked about beforehand. It's by position management and position size. So I definitely want to get into that. But first, I wanted to learn a little bit more about your fundamental process and something that I struggle with. How do you assess management and basically determine whether it's a good investment and they'll do a good job with the company, they have a good vision? How do you assess that? And and if you could throw in a few examples there, that would be great. Maybe in a stock that you thought it was good management, then they did something significant that basically changed your entire view of the company.
Well, I make mistakes too. I'm not saying that I'm right all the time.
Yeah,
but
absolutely.
After doing this for so many years, I realized that my hit rate is now maybe 70-75%. So generally, if I spend the time to do the research, I'm right more than I'm wrong, hopefully. Otherwise, I would be, running a fish and chip shop. But if you look at the management team, you have to look at, the pedigree of the management, who the CEO is, who the CFO is, who the directors are, who the shareholders are. You have to see, what their track record has been so far. With human beings generally, both professionally and personally, Richard, I've now learned or realized that the past is a pretty good indication of how that person is likely to behave in the future. So right. If somebody who has built an astonishing track record in the business world is now basically, leaving a well-established business to become the CEO of this new startup or this new company, you can pretty much be sure that this guy or this woman has done his or her homework and, jumped ship after, considering all the pros and cons. If a business person who's earning, tens of millions of dollars a year in a well-established business, they're not going to want to jump ship unless they see real potential. So the past of the business management team is a pretty good indication of, the quality of the business team, and also the directors, who the shareholders are. The shareholders also give you a fairly good idea of, the institutional sponsorship and what really, well-versed, intelligent, successful investors think of that business. So if any of the big hedge funds, sovereign wealth funds, pensions, endowments, SoftBank, and all these guys, if they are involved in a new company or in a new business or a new IPO, that actually piques my interest immediately because, I know that these people, they, are not silly or stupid. Otherwise, they wouldn't be managing billions of dollars. So these are some of the things I look at. I make mistakes also. I invested in Luckin Coffee before the scandal broke out. Fortunately, I basically wrote to the company when the ER was delayed, and they came back with some wishy-washy answer. So I decided to sell my shares immediately. I thought, this doesn't smell right to me. This doesn't pass the smell test. So I sold my shares, booked nearly 100% gain within 3 or 4 months. And I even posted it on Twitter for the benefit of my followers, saying, I've contacted Luckin. The response wasn't, sufficient or wasn't satisfactory. So I've sold my shares. I never tell people what to do with their money because I'm not a regulated investment advisor. but I basically said what I did with my own money. And a few days later, the scandal broke out and the stock basically went down a lot. But in that case, I looked at the management team, and I think the growth story was so compelling that I actually made a mistake, that I did not actually pay due weight on the quality of the management team. So that was a mistake, even though I doubled my money, but I still classify that as a mistake because I shouldn't have, invested in that. Something similar played out with Nikola. When Nikola broke out, there was a lot of hype, a lot of positive research reports and stuff. So I took a starter position in the company, and then I emailed the management of Nikola and asked them maybe 20 questions about, the prototype, about, how they plan to scale this business, what the costs were going to look like, and how they basically envisaged to becoming profitable. And interestingly, they wrote back and they said, they acknowledged my email, and they wrote back and they said, we would be happy to discuss this on a call, but we would not reply to you in writing. And for me, that is a massive red flag, because if a company is willing to say something to you verbally, but if they don't want to put this in writing, that to me is a massive red flag. So right. I basically, again, I was fortunate because I had a small 1% position, and the stock popped up a lot, and I think I made 40% in like 4 or 5 days. And then again, I sold out, and I posted on Twitter, that I've emailed Nikola's management. They have refused to reply to my questions in writing. I've booked my gains. This doesn't pass the smell test. And again, Nikola also turned out to be a bit of a problem. So, whenever I deviate from my own rules, which happens sometimes, I'm not perfect, I generally tend to pay the price. So I think nowadays I tend to focus very heavily on the management teams. And I've also been burnt in the past, in 2010, 11 and so forth, with some Chinese reverse mergers where, the CEOs and CFOs basically lied to me during the call when I organized the call to better understand the business when I was managing money for my firm. They basically lied to me, to my face, and they just cooked up with this incredible sort of stories to spin the business. So I generally now shy away from Chinese companies. I try and stay pretty much in the US or Europe or Singapore or those areas where you have
more regulation.
Exactly, more regulation, better jurisdictions in terms of regulation and penalties if management teams lie and so forth. And Russia is the only place where I've got like a small position in OZON, which has grown to become a sort of medium-sized position for me. But then the management team of OZON looks pretty credible to me, So this is the only exposure now I have. But otherwise, I tend to now stay focused in the real, grade A companies with reputable management teams and board of directors backing the business.
Awesome. And is a company being founder-led? Is that something you really look into and really that's what you prefer?
Absolutely. If the company is basically a founder-led business and the CEO is still the founder of the business with a big shareholding in the business, that to me shows that the company's CEO still has a vested interest to try and maximize shareholder value because his or her own money is on the line. I don't really like these companies where the CEO basically cashes out at IPO and then they have a rented person, a new CEO on a fat salary with not much ownership, basically steering the ship or the captain of the ship, because that doesn't play out very well because the person is collecting the bonus and the options, but they don't really have any personal skin in the game or money on the line. So I tend to focus on founder-led businesses because I've found that they tend to do pretty well.
Gotcha. And in terms of fundamental metrics, what are some numbers when it comes to sales growth or whatever metrics you prefer that would really catch your eye and basically make sure that you dive deeper into that company? And also, where do you kind of go to? What resources do you use, maybe software or a scanner, to basically look up those different metrics?
Well, the biggest factor that I look at is revenue growth because studies have shown that over long periods of time, say 10 or 20-year period, revenue growth has been the single most important factor for shareholder returns, even more so than EPS growth. Valuations play a part, but these studies have shown that valuations or changes in valuations are not the single most important determinant of how the shareholders, generally tend to do in those companies. So revenue growth has been the most important determinant on whether a company has been, shareholder friendly, or it has basically rewarded shareholders, or it hasn't. So I look at revenue growth, the past revenue growth, and also the future estimates of revenue growth, and the higher the. I also look at, the margins. I look at the gross margins. I look at the operating margins. I see whether the margins are actually trending in the right direction or in the wrong direction. So a lot of these high growth companies, Richard, they tend to be unprofitable, and they tend to be quite overvalued simply because, the market is aware that, a lot of the growth is in the future. So the market actually runs on expectations and it discounts the future. Right. So of course, you look at a company like Snowflake, which is expected to, grow its top line at, say, 40-50% CAGR or even higher over the next 5 years, is not going to be available at 10 times revenue. It's just not going to happen. So I look at, the future growth, free cash flows, what the management is saying about the cash flows, the margins, and so forth. And I look at the valuation. If the valuation is totally absurd, where I think I cannot even double my money over the next 5 years, then I pass. Like, for example, recently I've booked my profits in Shopify and also in AfterPay in Australia, because I think Shopify now is priced at such a massive premium, and the growth rates are likely to basically be around 30 to 35% over the next 5 years. So even if you assume a 30% revenue CAGR over the next 5 years, and if you slap a reasonable multiple of, say, 12 or 15, which is what Shopify used to trade pre-COVID, then I think the shareholder returns over the next 5 years are likely to be pretty disappointing. So I don't think I'll be able to generate a 15% IRR annualized over the next 5 years in Shopify, and the same for AfterPay. So I've sold my shares. So I try and keep an eye on valuation, but that is not the single most important thing that I look at. My goal is to try and own the best businesses that I can find, the businesses with the longest runways, the highest growth rates. And if I have to overpay, so be it. I'd rather own the top-notch companies as opposed to, sort of compromise on quality, go down the quality chain, and then, just because something is cheaper. From my experience, that hasn't really worked out in the past, and I don't think it will in the future, because investors, they all get attracted towards the best business. And those best businesses tend to compound for long periods of time, thereby rewarding shareholders.
Perfect. And getting into your strategy, take me through the process of actually building a position in a stock that you're interested in. So once you've done your due diligence, done all the fundamental analysis, when you're actually deciding how much capital to allocate, how do you actually go ahead and buy a stock? Do you look at a chart at all? And how do you make all those different decisions?
Sure. I look at the company. For Snowflake, for example, I love it so much. I put in 4% of my money in Snowflake. And then in this pullback, we've had, I bought in the mid 200s when I invested. I sold out when it went up to about 400, booked my profit. And then I basically went back in after a 30% decline. And then up until a week ago, I added more. So it's like a 5% position for me now. So, if it is a new listing, then what I do is I have like a medium-sized position. So if I like the company a lot and I think, well, this is real dominant business, and I'm absolutely sure that this business is going to do well over the next 5 years, then I may go in with maybe 3 to 4%. And if the company announces fantastic results, then, when my thesis is actually validated by the operating numbers of the business, then I may add more. If the stock gets punished in, a broad equity sell-off on Wall Street, and I think there is nothing wrong with the company itself, and this is just, emotional selling by people who are scared for whatever reason, because of its COVID or its, rising interest rates or whatever, then I add more, like I did with Snowflake. Some cases, if the industry is still pretty young, I may have like 1 or 2% as a starter position if I'm not really sure about the company, but I want to track it closely. I may, 0.5% or 1% just as a tester, so I can actually follow it and track it more closely. And if the company's management team disappoints, or if the numbers don't actually support what I was thinking, then I sell out. I don't really hang around and say, well, I am right, because ego is probably the biggest enemy in this business. In this business, you get rewarded for accurately assessing reality. You don't get rewarded for creating your own reality. This is a very important concept. If you are able to filter all the information properly, and if you are able to come up with logical conclusions based on that data and information, and are willing to change your mind very quickly, I think these are some of the traits of successful investors. If you get married to your position and you say, you know what, I am right, no matter what the incoming data is like. So for example, if you think Palantir is a good business, and Palantir announces weak operating results, and you say, well, Palantir is still an amazing business, and you just totally ignore what the results look like, or the actual business results look like, or what the customers are, thinking or doing with that company, then that is a recipe for disaster, because you have to be able to, change your mind, and you have to be able to monitor all the information, because this is one gigantic puzzle. The business world is not static. Everything is changing. New businesses enter existing fields. Moats get eroded overnight. I have to give you an example. I used to own shares of TDOC and GDRX, and Amazon announced entry into this field. And immediately, I thought, I don't want to fight Amazon. I don't.
Doesn't usually work out.
Exactly. I don't have the patience or the time to actually have a massive drawn out fight with Amazon. If Amazon is entering the space, and Amazon may not win. I'm not saying that, TDOC and GDRX are definitely going to lose this battle. They may win. But for me, there's easier fish for me to fry. I try and run away as fast as possible from those stories where, there is any sort of doubt or any sort of, murky waters. I try and fish in the clean waters where there is no problem or any sort of overhang on the business through, a competitive threat or any regulatory threat and stuff like that. But that's just me. Everyone has their own way of investing and trading. And I'm not saying anybody should follow what I'm doing or think that what I do is the best, but generally I like to sleep well at night. So if there is any problem in any other companies, and if I think that this threat or that this problem might actually be an existential threat to the company, I exit. Whether I'm making a profit or a loss, I don't care. I just want out.
That's awesome. That's awesome. Very cool. So personally, as a trader, I take into the fundamental growth numbers, the story, all of that. But I also view the current trend of the stock, whether it's an uptrend above the key moving averages, as a factor, because that kind of tells me in general net what the big money institutions is doing, how that stock is flowing. So for a stock, for instance, like Skills, now we're seeing a market recovery with the QQQ back near all-time highs, the SPY into all-time highs. Skills hasn't quite seen that same type of recovery. So do you take that into account at all, the technical weakness relative to the market, or that's not really a consideration for you?
Yes, I do. I watch the charts of my stocks. I've got a chart list, which I've been using for the last 10, 15 years, with all my charts plotted on a weekly basis, on a weekly chart, because I'm not a short-term trader or a swing trader or anything of that sort. So I don't really look at daily charts. I look at the weekly charts.
Makes sense.
So I look at that, and if a company is not performing, the stock is basically going down when the entire space is going higher, that to me is a red flag, because then I wonder, why is the market not enthusiastic about this company? What do the sellers know, which I don't know? What am I missing? So, my overarching sort of theme as an investor is, what am I missing? Because, it is what you don't know which kills you in this business, and more so, what you think is a certain way, but turns out that it isn't. That is what really kills you in this business. So obviously, if Skills is not performing when there is a massive rally going on in the growth space, I would be very worried. But if you look at the vast majority of the growth stocks, they've been down, and they still haven't participated in any sort of rally of late in the broad indices, simply because the market is still, adjusting the valuations of these companies, these high growth, long duration assets, because of the recent rapid rise in long-term interest rates. So if, to answer your question, if skills was down in the dumps in isolation and all my other growth stocks were, galloping higher, I would be more worried. But now most of the stocks, apart from, the bellwether growth stocks, they're all sort of struggling and failing to get any sort of traction. So I'm not really overly concerned about skills at this stage. Plus, the company's numbers were fantastic and the forward guidance is pretty good too. So I think that this is more related to the ongoing weakness that we are seeing in the growth space as opposed to any sort of problem with skills. I may be wrong. We'll see how it plays out.
Absolutely. It makes sense. And I love what you said. I think in response to my last question about ego, just pushing that aside, trying to be as objective as possible, and also being willing to completely change your opinion based on new information. I think that's really essential to both investing and trading. And it's something that on Twitter, I think people don't quite understand. Just because you like a company one day, if something changes, it's kind of illogical to keep that same opinion. You want to be as free-minded and open to whatever as possible. And I think that's a great trait to have as an investor and trader. And it's something that I always strive to do. So no, that makes perfect sense to me. And you phrased it very well. Getting into your position sizing, that's really how you manage risk versus I use stop losses to automatically, if the trend doesn't go where I think it's going to go, if a setup fails, stop losses get me out. That's how I manage risk. But you as an investor, it's really that position sizing that protects you in the long run. So can you talk a little bit about how you view risk management and how you apply it to your own investing, own trading?
For sure. I mean, position sizing is one part, Richard, but I also hedge my portfolio.
Right.
Basically, reduce the drawdowns when everything is tanking. Then the hedges kick in and basically protect my portfolio to some extent. So I have like a two-pronged strategy to avoid total disaster. So in terms of my capital, because I'm retired now, I don't have any other source of income.
Right.
I'm more cautious these days because obviously I don't want to wake up and see that all my money has disappeared. So I run a fairly diversified portfolio of say 20 to 22 companies usually. And now I know some people may say this guy is crazy. He thinks 20 is diversified, maybe 50 or 100 is diversified. But I've seen studies which have shown that if you own 20 to 22 companies, that is actually the sweet spot in terms of diversification.
Right.
And that number of holdings don't actually water down your returns either. So you are not diversifying with the WORS. Diversify.
Mm-hmm.
I mean, you can stuff your portfolio with a 50 or 100 or even 200 companies. And then my question to you is, how well can you track all the companies?
Yeah.
And what are the odds of your 200th or 100th best idea, being as good as your number one best idea? So, I mean, nobody has to go with what I'm saying. I'm just saying that, studies have shown that 20 to 22 companies give you the best RR in terms of risk reward, in terms of concentration of the portfolio, and also the diversification. If you add a 24th or a 25th company, you don't necessarily decrease your portfolio risk, but you certainly decrease your potential return. So I tend to stay in the sweet spot of 20 to 22. Occasionally, I may drop down to 17 or 18. In some cases, I may have 23 or 24, but generally, this is my sort of area. In my highest conviction names, I have 7 or 8%. If they tend to grow a bit larger and if I have really high conviction, fine. But I have seen, over time that most of my picks have performed. So, they tend to sort of go up together in terms of portfolio weightage. I don't let any company, get bigger than say 12, 13% of my portfolio, simply because of, risk management. Because if it gets too large, then of course you can do very well, but your overall portfolio then gets very, very dependent on that one particular company. And I don't like to, give my sort of a future in the hands of one company or one management. So I generally try and cap them at about 10, 12%. So if something gets really large and we have a big run up and the valuation has become nosebleed, I may actually trim some and bring it down to sort of 10, 12%, 10% or so, and then allocate to some other holdings which are temporarily depressed or beaten down. To basically explain my philosophy, I would say whenever I put on a position, Richard, I'm always looking at the downside first. So, I think, well, what is the consequence of me being wrong? How much will I lose if I'm wrong? And the math is simple. If you invest 10% in a company, and if the company turns out to be a fraud, the stock goes to zero, you lose 10% of your money. If you have a 20 or 30% position, if something happens overnight, there is a competitive threat, regulatory threat, something wrong with the company's operations, the management, then that 20 or 30% is at risk. So it all depends on how much you're willing to risk on a particular position. For me, I am quite risk averse, conservative, and I think a lot of people might find that hard to believe because I run a high growth, high octane portfolio. But believe me, I am pretty risk averse and conservative in my investment approach, and that's why I also hedge my portfolio. So I also hedge my high risk growth portfolio, or not high risk, but high growth, high beta growth portfolio by now shorting the ARK ETF. So for that, I use like a 100% systematic trend following strategy. So whenever the signals flash a downtrend, my hedges come on. And when the signal goes up to uptrend, I remove the hedges. So this is just my way of further reducing my drawdown, because I don't want to be in a position where, the stocks go down 50, 70%, and then they stay down for maybe a year or 2 or 3 years. And then I'm basically left, sweating and wondering when my portfolio will come back. Because if you have a 50% drawdown, you need 100% gain.
Right.
That's how math works, unfortunately. So if you are able to minimize your drawdown and reduce them to say 25, 30% or even less, then you are basically ahead of the pack, because all your competitors and your peers are down 50 to 70% in a brutal bear market. And with my hedging strategy, not only do I get portfolio protection, if we do have a massive crash like we saw during COVID, then you get profits from your hedges, which I basically am able to realize in cash. Right. And then I can use that cash at very low levels and then buy more shares of my favorite companies. So that is an added advantage. So for me personally, given that I'm now, retired and dependent on the growth of my portfolio for my for my day-to-day living expenses, I just find hedging indispensable. I wouldn't do without it, but again, everybody has their own investment objectives and needs and so forth. So they should, take whatever I'm saying with a grain of salt.
Absolutely. And what is the technical signal for you to turn on your hedges and also to turn them back off?
So I look at two moving averages on the ARK ETF. I look at a medium-term moving average, and I also look at, which is my trend filter. So if the price is over that medium-term moving average, I don't hedge at all. And if the price goes below that medium-term moving average, then I use a short-term moving average EMA Cross to tell me when to put on and remove the hedges. So when price goes below my trend filter, the medium-term moving average, and if the short-term moving average is also below the moving average, the cross is also on a sell signal, that to me is the time to put on the hedge. And when the short-term cross has a bullish cross, when the short-term moving average crosses above the other one, then I remove the hedge. But as long as the price is below my trend filter, I keep trading the cross to put on and remove the hedge. When price goes above the medium-term moving average, I stop hedging altogether. I just ignore the cross of the short-term cross.
Makes sense. And the medium term is the 150-day. Is that right?
No, I've cut it down even more, but I'd rather not say because the ARK is quite sort of
it's more volatile. Yeah.
More volatile, and also the number of shares which are available for short selling are not very much. So I don't want to give out what indicators I'm using now, because if I do and a lot of people follow what I'm doing, I may not be able to hedge my portfolio because of the shortage of the shares available for short selling. So this is just something I would like to keep to myself as to what indicators I'm using. If I was shorting the S&P futures or the NASDAQ futures, I would have no problem, explain or giving out my indicators which I'm using. But ARK is relatively thinly traded in terms of the number of shares available for short selling. So that's why I'd rather not give out which specific indicators I'm using currently to hedge my portfolio, if that's okay.
No, that's perfectly fine. And do you have an estimate about how well this method, I know you switched it up to the ARC now, you used to do the IWO, but how well did this help protect your portfolio in 2018, that pullback, and also the most recent crash and the correction in 2020?
Well, I didn't use the ARC for hedging in 2020.
Yeah.
In 2020, it worked very well. Sorry, in 2021, I started using it recently. So my portfolio is currently sitting on a 25% drawdown. But in the past, this strategy or the indicators I'm using now would probably get me hedged maybe 15% from the highs. So after a 15% drawdown, I'd be hedged or market neutral, which is what I'm prepared to accept. So if I have a 15% drawdown and my hedges kick in, no problem at all. I'm mentally pretty relaxed about a 15% drawdown. And I've backtested this new strategy also, and I've done the numbers. So given the indicators which I'm using now, and I've seen the backtest on ARK, KARKK ETF, going back to when it started trading 6-7 years ago. So 28% of the trades, hedging trades, were profitable. 72% were unprofitable. The unprofitable trades, the average loss per unprofitable trade was about 1.3%. So whenever the hedge turned out to be a whipsaw, you basically lost 1.3% on the hedging costs.
Not too bad.
Lost upside. And then the average gain per winning trade was about 5%. So over the last 5 or 6 years, the system actually would have put money in your pocket. So the hedging would have paid you as opposed to you paying for the hedging cost, which is fantastic because most hedges or insurance policies actually require, premiums and require some sort of lost upside or cost. But in this case, at least the back testing has shown that this hedging would have actually put money in my pocket had I followed it religiously. Now, I'm not saying that this is going to be the case in the future because nobody really knows.
Right.
But I mean, I would rather even pay 1 or 2% in hedging costs every year and have a smoother equity curve and a better quality of sleep and life as opposed to these wild gyrations. But that's again my personal sort of mental makeup. Everybody's different.
Yeah, no, makes perfect sense. And speaking of mental makeup, what have you learned to help deal with your high beta portfolio? Because it does fluctuate quite a bit day to day, especially when we are correcting and pulling back on the overall indexes. So what kind of tricks or things have you learned to relax yourself, try to remain as objective as possible, and just really follow your strategy and rules that you invest by?
It all comes down to the conviction in the companies. Whenever there is a big sell-off or drawdown, and the media is screaming the world is coming to an end, inflation, trade war, pandemic, war, geopolitical tensions, whatever the news story may be, I always, spend 10, 15 minutes every day just going through my holdings,
right?
Just mentally just going through each of them and thinking, well, is this business still sound? Is there anything wrong with the business? Has my original thesis changed? Is there any data point whatsoever in the past 24 hours which suggests that these estimates are not going to materialize? Is the business has the business announced some sort of downgrade, or has the business announced some sort of profit warning or revenue warning? And generally, if this is not the case, and if the business itself is still pretty robust and deeply entrenched in its customers' lives, then I just become pretty sanguine or relaxed about the whole thing. It doesn't really bother me that much. And it takes years of training and practice like anything else. If you are new to this game, obviously if you have a 20-30% drawdown, you think the sky is about to fall. And the human mind is very clever. It tries to extrapolate the recent events. So when you have a big run up, people think, oh, this is going to keep going up. Stocks can never go down. And when you have a big sell-off, the reverse, doom and despair sort of grips the human mind. And people think, oh my gosh, this is never going to recover. Such a bad company. I'm such a dummy for holding this. I might as well, sell this now and I go into something which is working right now. But that is basically the reverse of what one person should be doing, because if you are an investor, if prices are low, that is a good thing. And if you are an investor and if your stock has doubled or tripled or quadrupled in 6 months, that is a massive warning sign. That is a time to be super cautious, not euphoric, because you know that if something has already doubled or tripled or quadrupled in a very quick period of time, most of the future gains are already in today's price. In the latter half of 2020, in December, November, even early this year, I was periodically tweeting and saying that these stocks had run up so much. It's not normal for these stocks to triple, quadruple. The valuations were very high. There was likely to be a valuation reset at some point when the market basically became confident about the reopening of the economy. And that was the right thing for me to say at that time, but I was dumb in the sense that I did not actually raise some cash and protect my portfolio from this reset, which I saw coming, which is why I've now decided to hedge off the ARK ETF. So lower prices, if the company is sound, is a gift.
Right.
And I know traders would disagree, because as traders, you go solely by price. So if the base is broken or the moving averages are down, as a trader, you want to exit because you're playing a different game. But if you're an investor, then if prices go down and if the story is fundamentally unchanged, that is actually a gift. You should be buying more shares. Similarly, when you've had a massive run up and the valuations have become crazy and the sentiment has become crazy and the story is unchanged, then obviously, that is a time for caution. That is a time for basically taking some money off the table or putting some sort of, hedges in place or put options or whatever else you want to do to try and, protect those rapid fire gains. Because I can assure you, stocks don't usually triple or quadruple in a year. You're lucky if they do that in 5 years.
Right.
So what we saw in 2020 was pretty crazy. And the big sell-off that we've seen in this space is pretty logical, according to me, because if you have a 3 or 400% run up in 10 months, you're not going to get a 10% pullback. You are going to get a pretty sizable pullback to basically absorb or digest those gains and to basically, wash out all the Johnny-come-latelys, all the weak hands need to be washed out first. And then the next leg of the bull market will start. And I think we are going to see the next leg higher in these stocks. I don't think these stocks are going to disappoint over the next 5 years. I think from these levels, they're going to still produce pretty decent returns over the next 4 or 5 years. The only question is timing. And I think if the long-term bond yields start sort of calming down and drifting lower, I think that's going to be a big catalyst for these growth names to start rallying hard, because these are long duration assets. So the vast majority of the cash flows from these high growth companies are derived or likely to come from the future, 5, 10, 15 years from now.
Right.
And when you use the higher discount rate, the net present value of these companies goes down a lot. So the net present value of these growth companies is a lot more sensitive to changes in the risk-free rate than the net present value of the mature value cyclical companies. And that's why we've seen this huge rally in 2020 when the interest rates went down a lot. These stocks basically went through the roof, and we've had this big rise in long-term yields, and these stocks have had a big sell-off, and this is totally normal. But I think I personally don't think that we're going to see very high interest rates for a sustainable period. I think the 3 handle on the 30-year Treasury yield might be an area of significant resistance. So I think you may have a little bit more pain on the upside in terms of long-term interest rates. But for a number of reasons, I think that we haven't seen the end of the secular bull market in treasuries. Mm-hmm. The debt overhang is very large. The demographics also support lower interest rates. You have the reopening of the economy and the normalization of the supply chains, which is also deflationary. The velocity of money has gone down a lot. You have a lot of technological innovation and disruption, which is also deflationary. And also, if you look at the credit creation in the private sector, the loan to deposit ratio is at a record low. So all these factors now lead me to believe that we're not going to see very high inflation, at least not on a sustainable level or on a sustainable basis. I think we might see additional increases in the long-term bond yields over the next few weeks and months. But I'd be very surprised if interest rates are there a year from now or 9 months from now. I think once this, the sugar high from the fiscal jab wears off over the next few months, and the reopening of the economy is not as smooth as most expect, which I think is going to be the case, then I think long-term interest rates are probably going to drift lower again, and that's going to be a massive tailwind for the growth stocks.
Very interesting. And you mentioned your daily routine in there, going through your stocks, basically determining whether it's still a sound investment. Do you have a weekly routine or some other process for both analyzing your current positions, the market, as well as looking for new opportunities?
Not really. I am a full-time investor, so I do this most of the time during the day. So keeping up with the news, keeping up with the companies, researching new companies. So on a daily basis, I'm pretty switched on in terms of what is happening in the markets and the interest rates and the business world. But if somebody is not a full-time investor, if somebody does this as a part-time hobby or on a part-time basis, if somebody's got a business to run or a job to attend to, it can be quite difficult to focus so closely. So in that case, I think a weekly monitoring on a weekend or something is perfectly fine. But as I said, I'm able to devote several hours a day doing this because this is exactly what I do. I mean, if I didn't do this, I wouldn't know what to do with myself. So everyone is different.
Everybody's a little bit addicted to this. Everybody's really involved. So yeah, we really enjoy this. So that's awesome. When a company of yours or a company you're interested in reports earnings, what are the top few things that you're looking for, and what do you care about most when they have their conference call and report the numbers?
Well, I look at the growth of the business, revenue growth, profitability or the lack thereof, the margins, how many customers they signed up. If it's a software business, what is the net retention rate? In other words, how much more are existing customers spending the following year? The size of the deals. If it's an e-commerce business, I look at the number of users, the GMV, the number of orders. I also basically look at any metric which would give me an idea of whether the business or the platform is gaining in popularity or whether it is becoming less popular, whether users are flocking to the platform, whether existing users are leaving. I look at the average revenue per user, how much is the business monetizing, how well is the business monetizing these users, whether the ARPU is going up or down. So basically I try and get an idea of whether the number of customers and users is increasing or decreasing, the rate of change, the pace at which they are increasing or decreasing, and also how well the business is monetizing this user base or customer base. So these are some of the things I look at. And I also pay attention to the guidance from the management team. Usually these companies tend to sandbag, so they would basically give you a lower guidance so that they can beat. So they all play to some extent. But if a company is growing at 50% a year and suddenly gives forward guidance of 20% a year, that is a major red flag for me because nobody sandbags to that extent. So if the company thinks that they're only going to grow at 20%, surely the stock would get hit overnight, but probably I would sell in that instance. But overall, if the forward guidance is within my sort of expected range, then I tend to be patient.
Very cool. Very cool. And you mentioned something earlier on in the interview, which I think was great, not being married to a stock, which I think is a little bit different mentality than most kind of buy and hold investors. So that's interesting. But I think we've talked about extensively the fundamental analysis you do, what makes you buy a stock, but now shifting over to what makes you sell. What are kind of the key points there, both from maybe a stock that doesn't meet your expectations or kind of meets them too quickly, too fast, as for instance, in the case of Snow, which you said you sold after it ran up so quickly, that caused you to sell. So talk a little bit about your selling process and everything that factors in there.
Sure. Generally, I sell under 3 scenarios. One, if the company misbehaves. So if the management team does something wrong, or if there's some sort of scandal or the integrity comes into question, I walk away. I have no interest in lying in bed with crooks and cheats. So I just walk away. Secondly, if the business's growth rate slows down, in other words, the business has already, captured most of its TAM, and if the company is struggling to, grow at sort of the top line, so if the growth rate goes down to sort of 20% or lower, I'm generally not interested in owning these companies. So I'm interested in owning the young companies, which are still very early in the adoption phase, where they can grow very rapidly for several years. Those are the companies that I tend to focus on. So if the company is showing signs of getting mature, and the company is, suggesting that there are no additional business lines which are likely to come online, and then the growth rate is going to basically slow down markedly and basically become, and this business is going to become a slow growth, mature business as opposed to a hyper growth business.
Right.
That is a reason to sell. And commonly I sell when I find another new exciting IPO or a new company which has got massive growth projections, a new business, a new IPO, and if I need cash, because I don't have any other source of income or a salary or anything to basically inject money. So when I need to invest, when I need to own shares of a new company, I always have to sell some of my existing companies because I don't want to end up with a portfolio of 50 stocks.
Right.
So this is another reason why I sell when I need cash. And very, very rarely I sell when you have an insane rally like we saw in 2020, where in December, January, stocks were doubling in 6 weeks or 3 or 4 weeks.
Right.
That is always a sign of a euphoric sort of blow off. And that's why I sold, Unity, Palantir, Snowflake. I sold all these companies when they had these huge run-ups. And a lot of people on Twitter criticized me saying, oh, he claims to be an investor, but he's a trader and he's not really consistent because he's booking his profits. Well, I tell you what, all those stocks are now 50% below where they were when I sold from the highs or near the highs. And, when I invested in these companies, Richard, I was hopeful that I would probably be able to double or triple my money in 5 years. But when the market gave me the opportunity to double or triple my money in months.
In 5 months, not 5 years. Right.
Not 5 years, I had to sell. I could not sit there, with 60 times, 70 times price to sales multiples and having seen my stocks triple or quadruple in 4 or 5 months and do nothing about it. Had I done nothing, my drawdown would be worse today. So this is the number 4 criteria when I sell, but this is very rare because stocks generally don't triple or quadruple in a few months. They triple or quadruple in several years.
Makes sense. And you've mentioned valuation, and that matters very much to you a few times here. How do you determine that valuation? How do you determine if something's overstretched? And does it also depend on the type of business that you're also analyzing?
It does. If you look at, the software businesses, pre-COVID, these used to trade, the high growth names used to trade at sort of 12 to 15 times revenue. In January, they went up as high as 30, 40 times revenue. So obviously that was a major red flag. Mm-hmm. And what I do is I look at the current valuation or the multiple in the terms of software, for instance. And then I look at the revenue estimates over the next 5 years. So I try and gauge what the revenue of this particular business might look like 5 years from now. And then I try and slap a reasonable multiple. So for example, if you look at, the mature companies like ServiceNow or Adobe, for instance, they are currently trading at 12, maybe 14 times revenue. So I think, okay, in 5 years' time, if a high growth business I currently own slows down, which is inevitable, right, then assuming a 10 to 12 multiple or 15 multiple on that revenue 5 years out will give me X market cap 5 years out. And this is the current market cap. And then I basically, do a quick check on a compound interest calculator to see, if the current market cap is this is the likely future market cap 5 years from now, what is going to be my annualized return? And if the annualized return is north of 15%, I then tend to stay invested, or I'm interested in the investment. If I feel that, the current market cap is already so stretched that all I'm going to do is make maybe 5 or 6% a year realistically over the next 5 years, I sell out like I did with Shopify and AfterPay. So it's a case of trying to see what the business will look like 4 or 5 years from now, and also, slapping what I consider to be a reasonable multiple on that number, and then trying to figure out my return as a shareholder.
Makes sense. So you're using price to sales versus PE ratio or some other metric?
It depends on the company. If the company is profitable, then yes, I also look at the PEG ratio and also the price to earnings multiple. But a number of these companies, as you know, they are unprofitable. They are trading on future profitability because the companies are reinvesting heavily in their future growth. So in these cases, I tend to look at the EV to revenue multiple, sales multiple, or even the free cash flow in some cases. So it pretty much depends on the industry and the type of business I'm trying to analyze.
Very cool. Very cool. All right. I also wanted to ask you, because it seems like you're always changing a little bit what you're trying to learn more. So what are some mistakes in the past that you've really learned something substantial from, that maybe you think people watching might benefit from the lessons you learned? And also, what are some things that you're currently working on improving?
Well, the biggest lesson for me has been, controlling your ego. Because, in my case, I was very fortunate in the sense I became very, very successful very early in life. I was, the founder of a big investment management firm here in Hong Kong with 150 people, managing, a large amount of money. I had, regular monthly columns in newspapers and magazines, and, regular interviews, 4 or 5 TV interviews a month with all the major channels. And some of that success basically got to my head, I must admit, because I thought, I must be very good at what I do because I am, highly sought after. And it basically tainted my objectivity to some extent. And I started, for a brief period of time, thinking that perhaps I know more than anybody else, or I'm right and everybody else is wrong. And then I paid the price for it heavily when the commodities collapsed in 2008 or 9. And that basically was a big sort of kick up my backside, and a big lesson that, always keep your ego and the size of your head in control. You are only as good as your most recent track record. All it takes is one wipeout to finish you off in this business, especially if you're managing other people's money.
Right.
So I would say remaining humble and not getting arrogant is a very important lesson which I've learned, and I would urge your viewers and listeners to keep in mind, and especially the young people, and especially those who started trading or investing in 2020 March, because what we saw from March 2020 to Jan-Feb 21 was highly unusual, abnormal.
Right.
This is how a market functions. The best investors compound their capital at 20-25% a year over extended periods of time. So, what we have seen was not the norm. And I can guarantee you that it is not going to be the norm going forwards. So, most people should adjust their expectations to a much lower rate of return going forward. And the other lesson I have learned over time, Richard, is that, the very best companies with the biggest runways and the biggest capability to compound over long periods of time, they tend to look overvalued most of the time. And not investing in those companies and passing up on those businesses purely based on valuation is a very bad idea. So if I was, 15 years younger, I'm 44 now, but if I was 15 years younger or just starting out, I would say, don't value businesses based on the current multiple. Look at what the business will look like 4 or 5 years out, how big their TAM is, how big their runway is, what this business will generate 4 or 5 years out. Will they still be growing rapidly then? What will this business generate 10 years out? And then see whether the business is basically overvalued or not. And you have to also realize, the market is not rational all the time, because when you have, sentiment extremes, whether you've had a massive run up or when you have like a panic takeover, the market can be pretty irrational. But most of the time during, calm periods, investors are generally rational. So if a company is trading at 40 times revenue like a snowflake, most people will say, oh my gosh, I'm not touching that because that is so expensive, it's a bubble, it's crazy. But then you have to realize, why is this trading at 40, 50 times revenue? You have to look into that, and you also have to realize that, okay, a snowflake started trading in the public markets in the low 200s, and then it had a run up to 400. Most of the FinTwit accounts did not invest in this because they said, oh, it's too expensive. So from 440 or whatever, after doubling, it came back down to around the low 200s, mid 200s again. So a lot of people are still screaming that this is so expensive, but it is interesting to note that the price hasn't really gone down below 200, has it?
Right.
So, you know that somebody with deep pockets or a bunch of people with deep pockets are supporting and they are buying these shares at this level. And obviously they see something in the future, otherwise they wouldn't be buying it.
Right.
So, for me personally, I would rather pay up for an exceptional business than basically compromise on the business itself and settle for a mediocre business just because it's cheap. So this is the second most important lesson I've learned in my 20-year investment career.
That's great. That's great. I think Bill O'Neill, the author of How to Make Money in Stocks, there's a quote, what seems high goes higher, what seems low goes lower. That basically sums at that point perfectly. Awesome. So fantastic, Puru. Thank you so much for all this incredible information, especially on the fundamental side of things, which I'm always trying to learn more about. I always like to end the interviews with this one question. And you kind of touched on it a little bit just in the previous response, but what is your advice for somebody completely new to this, just starting out, maybe, as you said, starting out in March 2020? What can they do to speed up their learning curves and try to get on the right path and to be successful in the long run?
Well, treat stocks as pieces of businesses, okay, and have a shareholders or owners mindset. Because when you buy shares in a company, you really are a small owner of that business. If you're a trader and you're gifted, I'm not the right person to seek advice from because I'm not a trader. But if you are an investor who's just starting out, or if you are somebody who has a day job, or somebody who is looking for, increasing your wealth over the next 5-10 years, I would look at focusing on the handful of disruptive high growth companies. And data has shown, Richard, that over the last 100 years or so, the vast majority of the gains from the stock market or the indices have come from a handful of stocks. Just 4 to 5% of stocks have been responsible for the vast majority of the gains in the stock market. So that basically shows that stock selection is absolutely critical. If you feel that you don't have the time or the inclination or the experience or the knowledge base required to pick stocks, then invest in a bunch of ETFs. Invest in the S&P tracker, the NASDAQ. You can buy the ARK ETF for innovative tech companies. You can buy Chinese ETFs. You can buy India ETFs, emerging markets. So there's no shortage of ETFs. So for most people who are not inclined and are not willing to put in the hard work necessary to run a concentrated portfolio, should just opt for ETFs, and they should just ignore the short-term gyrations and only invest money in those ETFs which you won't need for the next 3 to 4 years, because sometimes you have bear markets and then these ETFs go down, they don't go up to old highs for many years. So don't invest money which you might need in the immediate future. If you are interested in owning shares, then try and focus on the really dominant high growth companies and put together a portfolio of maybe 20 to 25 companies, which is, as I said earlier, is the sweet spot in terms of diversification and concentration. And then not get swayed by the sentiment on Twitter or on the mainstream media, because the media's job is to, grab eyeballs. They're only interested in increasing their viewership. They don't want people to turn off the TV and walk away. They make their money from advertising. The people who go on media make their money by, talking up their book or their business. So if you're an asset manager, you're going to talk up your book. You're going to tell the whole world how wonderful you are. If you are short something, you're going to go and say how crap this thing is, how it's going to implode, how it's going to zero. So everybody is biased. Nobody is interested in you making money. They're interested in basically making money for themselves, whether it's the media or the advertisers or the fund house or analyst or whoever. So you have to be able to have conviction in your picks, in the holdings that you have in your portfolio. And then you have to basically be able to ride out the volatility, because volatility is normal in this business. If you are going after high returns, say, for example, the S&P has delivered a compounded annual return of almost 10% going back 50, 60 years. The flip side is that shareholders of the SPY or of the index tracker have had to endure volatility. The standard deviation of the S&P is around 15 to 17% per year, if I remember correctly. So if you are targeting a higher return, higher than fixed income, then it is only natural that you would have to basically endure some near-term pain and discomfort via a higher volatility. There is no free lunch. You cannot hope to achieve 10% annualized with bond-like volatility. Otherwise, bond investors won't invest in bonds. Everybody would buy stocks. And similarly, if you are playing the high growth investment game, and if you're investing in disruptive companies which are growing very rapidly, then you may be able to make a higher return than, say, owning an SPY or an index tracker. But the flip side is, because you are going to be rewarded with a higher return, you will have to even higher volatility and drawdowns. As I said, there is no free lunch in this world, unfortunately. So if you are going to run a concentrated high growth portfolio, be mentally ready for 25, 30% drawdowns periodically. And sometimes you may even go down 50%. And you have to be pretty sanguine about the whole thing. If you are able to withstand these periods of discomfort and these drawdowns, with a very casual attitude without getting too worked up, then I think you have all the hallmarks of being a good investor. If you are one of those people who panics every time your account dips 10, 15, 20%, and you imagine the worst, and then you try and sell at the worst possible time, which is after a big drawdown, then probably a basket of ETFs is the best option. Or you should also own a few fixed income securities or bond ETFs to sort of minimize your volatility. So I think a strong stomach is more important than a strong brain, as Peter Lynch used to say, decades ago, and I think he's absolutely right. A strong stomach is more important than a very high IQ in this business.
Perfect. I think that sums it up very well. We'll leave it there. For everybody watching, thanks for tuning in. Remember to leave a like down below if you enjoyed the interview, and subscribe to the channel if you want to see more great interviews with investors and traders like Puru. So Puru, thanks again for sharing your knowledge and spending the time with me today. Really appreciate it. It's been great to finally connect and meet you face to face after interacting on Twitter for over a year now. So thanks again for coming on the show, and we really appreciate it.
Thank you very much, Richard. Pleasure to talk to you.
Yeah, a pleasure. All right, well, we'll leave it there. Thanks so much for watching the video. And if you want to see more ones, remember, go ahead and subscribe, and I'll see you guys in future videos.